movers revolutionized our world. It's time we revolutionize theirs. For those who bravely stand at the crossroads of innovation and enterprise. For those who are prepared to give our children a moral compass and not just a roadmap. For those who wish to leave the planet better than it was when we found it. For those who are driven. For those who dare to reinvent. For those who dare to reimagine.
Founder of Nikola Motors facing years in prison following his conviction on fraud charges.
The founder and former executive chair of Nikola is now on trial in New York. He's charged with lying about the company's products to mislead investors and prop up the stock.
Of course, we're talking about the big deal that's going on with Trevor Milton and his charges of 3 counts of fraud from federal prosecutors.
Federal charges will be filed today against Trevor Milton.
Trevor Milton, the founder and executive chairman, stepping down.
They said it was the future of trucking, a zero-emission revolution that would disrupt diesel and make electric look old. Investors believed it, and the stock exploded. At its peak, Nikola was worth over $34 billion, with almost no revenue. What went wrong? And how did a company become famous for a truck that rolled downhill? Today, we break down the rise and fall of Nikola, the hype, the partnerships, the staged demo, the investigations, and the lessons that every founder, investor, and executive needs to hear. This is Business Breakdown Channel. Let's get into it. What happens when you promise the impossible and investors believe you? Nikola's pitch was simple and massive. Hydrogen fuel cell trucks and battery electric semis that would outrange competitors, refuel fast, and transform freight. The story had all the right ingredients: a charismatic founder, Trevor Milton, flashy unveilings, and a plan to build a nationwide hydrogen network. Partnerships added credibility. Anheuser-Busch announced a large order. Bosch and CNH Industrial were named as technology and manufacturing partners. Media coverage poured in. Then came the SPAC. In June 2020, Nikola merged and went public. The market went wild. For a brief moment, Nikola's valuation exceeded that of Ford. But here's where it gets interesting. Behind the claims were unanswered questions. How much of the tech was real? How much was outsourced? And how much was presentation? SPACs are blank check companies that raise cash first and find a target later. In 2020's liquidity flood, SPACs offered speed, quicker listing, forward-looking projections, and outsized media attention. Nikola's investor deck leaned into this moment. Total addressable markets in the trillions, a hydrogen network spanning North America, and multi-year revenue ramps uncommon for traditional IPOs. Those forward projections, while technically permitted in SPAC contexts, created expectation gravity. When targets miss, the gap between promise and delivery becomes an accounting, legal, and reputational drag. Nikola rode that expectation wave up. Meeting it required flawless execution across hardware, infrastructure, and supply chain. That's where reality bit. In September 2020, Hindenburg Research published a report, Nikola, How to Parlay an Ocean of Lies into a Partnership with an Auto OEM. The headline allegation that captured the internet, a promotional video showing the Nikola One driving on a road, was filmed with the truck rolling downhill. Nikola responded that the video never claimed the truck was under its own power. Technically true, but the impression was clear. The report also challenged claims about in-house tech, hydrogen costs, and timelines. Within days, scrutiny intensified. The SEC opened an inquiry. The DOJ followed. Trevor Milton resigned as executive chairman, and the stock began its long descent. This wasn't just a failed demo. This was a company built on lies, exposed by a truck that couldn't even drive itself. Public presentations implied proprietary breakthroughs across batteries, inverters, gearboxes, and hydrogen production costs. Subsequent disclosures indicated significant reliance on suppliers for many subsystems, with technology at varying stages of maturity. In hydrogen, headline cost targets assumed renewable power pricing, high utilization, and multi-year learning curves, assumptions that rarely hold during early rollouts. When marketing language blurs roadmap, prototype, and production, investors can misread engineering risk as commercial readiness. The downhill video became a symbol of that blur, a real chassis in a staged scenario framed as momentum. How do you spot the difference between innovation and illusion? Strip away the hype, and Nikola still had a real thesis: decarbonize heavy trucking. But execution lagged expectations. Hydrogen economics were tougher than investor decks implied. Building a network is capital-intensive. Vehicle development takes years, suppliers miss, and validation cycles are unforgiving. Some partnerships were memorandum level, not binding long-term commitments. The Badger pickup was shelved. Supply chain complexity surged. And without a proven unit, revenue remained limited while cash burn continued. Meanwhile, competitors advanced. Tesla pushed semi-milestones. Traditional OEMs iterated on electric platforms. The window for first-mover advantage narrowed, and capital markets became less forgiving. Hydrogen trucks can excel on fixed routes with depot fueling and high daily utilization, especially where battery mass or charge time is punitive. But low-carbon hydrogen is energy-intensive to produce, costly to compress, and expensive to distribute without scale. Station CAPEX permitting, and safety engineering add delays. Early molecules are dear, later molecules get cheaper, if fleets commit. That chicken-and-egg dynamic makes timelines slippery and projections fragile. Battery electric, by contrast, used existing electrons and maturing charging networks. For investors, comparative simplicity mattered. For Nikola, the bar to prove hydrogen's TCO advantage was always going to be high. The technology wasn't impossible. The timeline was. When Trevor Milton went to jail, Nikola faced a critical question. Could the company survive without its charismatic founder? The answer was yes, but with massive changes. New leadership immediately distanced itself from Milton's vision, focusing on realistic, achievable goals rather than world-changing promises. The GM partnership, once a cornerstone of Nikola's strategy, was completely renegotiated. Equity stakes were reduced, manufacturing plans were scaled back, and the Badger pickup was permanently shelved. GM's message was clear: we'll work with the company, but not the founder's vision. This became the blueprint for how partnerships evolve when trust is broken, but the underlying business case remains. Here are the 4 key lessons every entrepreneur and investor must learn from Nikola's collapse. Lesson 1. Proof beats presentation. If a demo requires caveats or disclaimers, it's a marketing asset, not an engineering milestone. Say what it is, not what you wish it were. Lesson 2. Partnerships signal potential, not production. Until purchase orders convert to actual shipments with real margins, treat partnership slides as hypotheses, not guarantees. Lesson 3. Infrastructure businesses need infrastructure capital. Hydrogen can work in constrained networks with anchor tenants, but nationwide promises require time, money, and ruthless focus on execution. And finally, Lesson 4. Founder charisma is a multiplier, in both directions. It can raise capital quickly, and it can destroy trust even faster when promises don't materialize. The market doesn't care about your story. It cares about your results. Now that we've seen how Nikola collapsed, let's turn this into actionable intelligence. Every investor faces the same challenge. How do you separate real innovation from clever storytelling? How do you spot the next Trevor Milton before he takes your money? The truth is, most frauds follow the same playbook. They promise revolutionary technology, show impressive demos, announce big partnerships, and raise massive funding. But behind the curtain, the technology is either fake, borrowed, or years away from reality. The key is learning to ask the right questions and demand real proof. Here's your 5-point checklist to avoid the next Nikola disaster. Use this every time you evaluate a startup, whether you're an angel investor, venture capitalist, or just someone who wants to understand what's real and what's hype. First, demand third-party validation for core tech claims before assuming scale economics. Don't take the company's word for it. Second, separate letters of intent and memorandums from binding orders. Weigh counterparties' incentives and exit ramps carefully. Third, map infrastructure dependencies and calculate the true cost of first stations, not end-state averages. Early costs are always higher. Fourth, insist on transparent prototypes. Know what actually runs, what's mocked, and what's supplier intellectual property. And finally, fifth, underwrite teams on domain depth, not just prestige boards and media pull. Experience beats charisma every time. Will you be the next investor to fall for the story?